Hi everyone, and welcome to the webinar on quant finance and algorithmic trading. We have Sanyal with us. He's one of the experts in this domain, and we'll start the webinar in a minute. Just a quick check, you are able to hear me clearly? Great, thanks Aryan, thanks Shekhar. For those of you who are who have been in our webinars in past, you know the interface. So we are live on Facebook as well, so you can follow the webinar from there as well. So let me quickly introduce Deep. He's already here, and then we'll start the webinar. So a quick background. So as you all know, this webinar is happening as part of DataFest 2017. The topic for today's webinar is quant finance and algorithmic trading. I have Dipyaman Deep Sanyal with us for the evening. He's one of the experts. So he's currently the head of analytics program at Bridge School of Management. He also runs his own consulting firm by name of Dono Consultancy, which specializes in market research. He also is a CFA charter holder and has done his MS in economics from University of Texas. So with that, I'll just quickly go over the things which are happening as on DataFest. So you would know this already, so I'll quickly cover them. So there are multiple events happening as part of DataFest. This webinar is one of them. There is a machine learning hackathon coming up in next week, and there are a couple of competitions coming up over the weekend. So we hope to see you there as well. As I said about Deep already, he brings a lot of insight and practical experience on the subject. So I wouldn't take a lot of time from him. Actually, just wanted to share something. So it's this webinar is on a subject which I always kind of wanted to learn from Deep, but never got a chance to learn from him. So I guess I'll also learn while he presents the material to people. So with that, let me just bring Deep on board as a panelist, and then I'll pass on the controls to him. Just give me a minute.
Okay, I can see myself. Hey Kunal, how are you?
Good, I am good. So I'll pass on the presentation controls to you. I'll just skip my, in fact, you can start taking controls over. I'll just put myself on mute. So let me know in case you need any help from. I'm keen to learn from the subject, so I'll pass on the controls.
Thank you. That was a very, very kind introduction, Kunal. Thank you very much. I really appreciate that. The idea behind today's webinar is we talk about quant finance, we talk about algo trading, but a lot of the material is fairly intense, fairly mathematical, in some places extremely technical. We don't dig deep into that. What I want to do is give you some technical details, but also to give you a roadmap of sorts, to give you an overview of what does a quant do, what would you do if you were doing algorithmic trading. So details about the equities market, the fixed income markets, because all of these, especially derivatives markets, there's a lot of quant trading going on. And then we'll, of course, open it up for questions. So I'll just share my screen with you guys and get to the PowerPoint. Just 1 second here. All right, can you all see the PowerPoint? Kunal?
Yes, we can.
Okay, perfect. That's great. So so when Kunal talked to me about doing this webinar on algo trading, the initial idea was to work primarily with and talk primarily about algorithmic trading. And I said, you know what, let's move on and go beyond just algo, because part of it, and we'll discuss this a little bit more, is algorithmic trading, given the technical needs of it, and given that it's not a data sciencey subject. Let me tell you that up front, right? If you look at the algo trading world, you will find a lot of quants doing a lot of fancy things, but you won't find too many data scientists yet, and I'll give you the reasons for that. So that's why we broadened the objective of covering both algo trading and quantitative finance, because I think quant finance is where more data scientists, analytics professionals, predictive modelers are doing much more interesting things. So we'll begin with algorithmic trading, move on to quantitative finance, which are kind of, go together hand in hand, and then we'll throw it up to questions. All right.
If we have lost your presentation.
Yeah, can you see the presentation now?
Yeah, we can see that, yeah.
Okay, all right, let me. All right, the first slide was kept, like this because it's very messy, right? You can barely see what the title is. This is so much clearer, and the world of quant finance is essentially that. You're trying to figure out what the thing really means when there's so much garbage all around it, all these numbers being thrown at you, live stream data tick by tick of every equity that's being traded. So this is broadly the primary categories of quantitative finance, and this is of course very broad and personal. What I think are the broad categories. You ask any quant finance professional, and they will have a different idea of it, right? My perspective comes from my work in the field, primarily from a hedge fund perspective, because that's where I, did most of my quant work. So I used to work in a quantitative finance. It was a broader hedge fund, but I used to work in a quant team, and at some point later started leading the quant team there. So working on algo trading, working on quantitative finance, doing primarily fixed income, but also some equities. So broadly categories, algorithmic trading. This is meant primarily for very liquid markets. If it's an illiquid market, there is no way you can set up algorithmic trades, right? So these are rules-based, and you would follow certain rules, set up certain rules, and build your algorithms based on those. And then there's, of course, high-frequency trading, which is also algorithmic, which is also rules-based, but it's all about speed, right? So rules-based trading, algo trading does not necessarily have to be all about speed. It can be machine learning-based and can be much slower. High-frequency trading, of course, it's all about the speed, and we'll talk more about that. The broader quant finance area for liquid and illiquid market covers, number one, options pricing. Derivatives of every sort, futures, options, forward trades, all of these guys, whether it's commodities, equities, currencies, this is arguably the largest market among all asset markets from a notional value. And this is where most quant work is still done. The second part we'll talk about as well is risk management. A lot of quants who you would meet doing their MS in quantitative finance and so on, real experts in mathematics, a lot of PhDs as well, work in the risk aspect of it, because not everybody has the risk appetite to go and become a trader, a quant trader, right? So a lot of folks you would see instead decide upon working on the risk side. And of course, then we have the people who work in the fixed income side, which is again a very, very large market, right? So these are my primary categories, and we'll walk through each one of them. So what is algo trading? The picture on the left, this is what we think it looks like, wonderful, lots of blue screens with charts and graphs going up and down, and the markets being made at the speed of light. On the right is what it actually looks like, all right? It's not as cool. It doesn't look like the chart on the left. What you have is enormous amounts of data pouring in, which needs to be cleaned and normalized. A lot of it is tick by tick data, so trade by trade data. Think about it. Any stock that you can think of in a broader stock exchange probably is traded a few million times every day. and sometimes it becomes in the hundreds of millions. Every time a trade is done, the data is collected and all that data comes into your system, right? So you need to normalize it. You need to figure out how to wrangle that data and make sense out of it. With that, once you have an usable feed, you plug in your trading strategy. At the same time, you plug in your risk management and you have your execution strategy. Now, note this, because this becomes a very, very important part of high frequency trading. The trading strategy might be machine learning based, but execution strategy is actually the largest part of high frequency trading. And then you have exchange interfaces through which you go ahead and actually place the trade. And then you have all sorts of this data going into your profit and loss management systems. So here's the disclaimer, and which is why, as I said, we didn't keep this restricted to algo trading. Algo trading is more computer science and coding than machine learning, statistical modeling, and quantitative finance. It's a lot of hard coding. You can have algorithmic tradings of different kinds. You can have simple rules, right, which can be automated if you have the right interface through which you can trade. So what sort of rules are we talking about? We are saying that, hey, look, we can have a simple rule like buy a stock when it's above its 50-day moving average. I'm a momentum trader. The moment something goes beyond the 50-day moving average, buy it. Sell it when it's below 50-day moving average, right? And in between, there are these basis points where you're making money. So algo trading can be incredibly complex, but it can be also very, very simple. And you have a simple rule which you want to implement, which you can do it directly with the exchange interface. Now here I'll give you a quick update on what does it look in the Indian perspective. You can do this at home, right? All you need to do is set up an account as a broker and pay a nominal fee of, I think, 750 rupees a month to some of these brokerage houses. And you can actually set up an algo trading account on your own and try these things at home. So what are these algorithms trying to do? They're trying to emulate human behavior, but on speed and without the biases. Because look, when you have a human being trading the market, one of the key problems that we find, and it's, you see this, what Alan Greenspan had once said, irrational exuberance. People suddenly become very pleased about something, or people get very depressed about something. There's some bad news coming in, and we go sell, 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 and we all start moving in the same direction. Because we are biased, and human beings use mental shortcuts. They do not optimize, they use mental shortcuts to take decisions. One of the key examples is loss aversion. We don't like to lose money. So if I am buying some shares and it goes down a value a little bit, I might worry about it too much, despite knowing that there's a lot of value left in it, and not sell it. If I think, if there's new information which says that, you know what, this share is actually going to go down, let's cut our losses and get out. We never want to do that. We are averse to losing money. We would rather keep holding on, hoping that someday it would turn around. It happens to all of us. Machines wouldn't do that. Algorithms follow rules and do not get emotionally carried away. So if we can use algos to predict human behavior and thus market behavior and stick to the rules, we can win. Additionally, high-frequency trading algorithms can react much faster in picoseconds to market-moving news. And if you're doing a very, very large trade, which is why all sorts of hedge funds and banks use high-frequency trading, if you're a large trader, even a millionth of a second gain can make a very large windfall. So what are the types of algorithmic trading? High-frequency trading, this is the biggest one, right? Because we know that high-frequency trading now accounts for over 50% of trades, even in developing markets like India. The NSE high-frequency / algo trading is about close to 50% by volume, according to new data. In the US, the estimate is about 70% plus. Most of it is high-frequency trading. HFT is also rules-based trading. It's not like, it's just about speed. You have certain rules in place which are followed by your algorithm, and that's how you trade. But in HFT, speed is the name of the game. So I'm going to talk about an example, right? And this is stuff that happened in real life about, let's say, 10 years back. This is when, all these people, all the Goldman Sachses of the world started getting data centers very, very close to where the news comes out from. So let's say the Fed might raise the interest rate. From the time the words leave the vocal cords of Janet Yellen, who heads the Federal Reserve Bank of the US, it's transmitted through television cables or satellite signals, then passed on to your brain by your ears, and then leads to a reaction from your finger, which presses the sell button. The algorithm has shorted the market for over $1 billion by that time, right? So this process that happened at breakneck speed, right? Because it's satellite signals being sent to you, that 1 second or 2 second delay that happened between the actual announcement by the Fed and you hearing it and pressing the sell button, within that second, right? The algos have undercut you, moved faster than you, gone in there and placed billions of dollars of trade. So by the time you move, right, based on the news that has been given to you, the trade is already over. Somebody's made money. They're moved on, right? The information got priced into the market within milliseconds or even picoseconds of it actually leaving the vocal cords of the Federal Reserve Bank's governor. But that's the cool part of it. It doesn't always work like that. Most rules-based trading is all about getting better execution. It's not about high-speed chases for information described above. It's pretty boring. So what sort of stuff do high-frequency traders usually look at? VWAP, volume-weighted average price. What it does is it breaks up large orders and releases them in tiny chunks based on historical volume. And you can also do that based on time as opposed to volume weighted, which is called time weighted average price. So what's the story? The story behind this is hedge funds, banks, mutual funds, when they place a trade, it runs into the millions and billions of dollars sometimes, right? Or hundreds of millions of dollars. If you trade on that piece of information, you cannot just go into a broker's system and say, you know what, I want to buy $100 million worth of Citibank shares. You can't do that. It doesn't work like that. And if you do that, if the person on the other side who's selling is probably selling a few thousand, the next person who's selling, right, would start charging a lot more because they can see on their systems that there's a large buy order in the market. The exchanges, everyone who's going to take the counter side, who's going to sell the shares, will get to know that somebody on the other side is planning to buy $100 million worth of Citigroup shares. That is going to completely mess up what your plans are, because what you are trying to do with an algorithm is minimize the difference between your decision price and the actual execution price. That's what an algo is primarily doing. That's what high-frequency trading is mostly about. Let's say I'm a portfolio manager and I decide that Citigroup shares look wonderful at $5 a piece, right? Now that's my decision price. That's when my analysts and the fundamental analysts and technical charts, whoever have come up with this great idea, let's buy Citigroup shares for $10 million at $5 a piece because that seems like a great price for these shares. I call back my trader and I say, let's buy $5 million worth of shares or $10 million worth of shares at $5 a piece. That's my decision price. The execution price is the value or the price at which it actually gets bought from the market. And usually there will be a difference between your decision price and your execution price, because if you have seen the price on your Bloomberg terminal that it's $5 a piece, it's very, very unlikely that you will get to buy it at $5 a piece. The moment you send a large order out there, people will start moving up their prices. So what your high-frequency trading algorithm will do is it'll break up your large order into small pieces. It'll break it up for a few $100,000 every time somebody's willing to sell, buy it up, right? So keep adding liquidity to the market without letting the market know that you are trying to do a huge trade in Citibank shares, okay? Now, that's not very much fun. That's not as interesting as chasing information across the internet highway, all right? But most algorithmic trading, that's what they're doing. So according to Marco Avellanda, who's one of the legendary NYU math professors, these are some of the reasons why algorithmic trading is done, right? This is a list directly picked up from his site. If you look at this list, you will see that there is no machine learning or quantitative finance in there, all right? What are the reasons? Institutional clients need to trade large amounts of stocks. Large stocks If you want to move, they're going to impact the price. You want to do it without impacting the price. Second, demand for a large amount of liquidity will typically affect the cost of the trade in a negative fashion, which is called slippage. You don't want slippage. Large orders need to be split into smaller orders, which will be executed electronically over the course of multiple days sometimes. The process for executing this order will affect average cost per share. And in order to evaluate an algorithm, we should, go back and benchmark its performance. Again, what are we benchmarking it against? Not about performance of the trade, but performance of at what price could I get those shares. It's all about execution and perfecting execution. Okay, so what's your benchmark when you have run a high frequency trading algorithm to buy your Citigroup shares at $5 a piece? The benchmark is, it can be opening price, it can be global average of daily price. Your global average of daily price is the price that you saw, and that was your decision price, let's say $5. You landed up buying your shares at an average price of $5.02. Those 2 cents is actually what you're trying to save when you're using high frequency trading very often, right? So not as cool, but it really does move the markets. So we come to tools of algorithmic trading. What are the tools that are typically used in algo trading, in high frequency trading especially? High frequency traders are notoriously snobby about their tools. You will see people using C++, C#, Java. You will rarely ever see anyone using R or MATLAB. Actually, you just won't see it. You wouldn't see a very well-known high-frequency trader or a quant finance trader using MATLAB or R. There's a little bit of Python, and I'll talk about it, but that's usually used for prototyping. However, what's the good news? There is a lot of machine learning algorithms which are starting out in the world of algo trading. It's increasing. There's a lot more interest now. And on a given algo desk, you will find people, right, using R and Python. You'll find people who are data scientists. Unlike before, when we started working on this stuff, most people on the desk either had an MS in quantitative finance and were very, very mathsy, and the older guys all had PhDs. They were PhD physics or math from top universities. So to be a good algo trading quant, you have to be an excellent coder. And it's all about low latency programming. It's a lot about low latency programming. It's not about building trading strategies often. It's about making sure that there is little or no redundancy in your code, so that once you press that button, your execution is fantastic and time sensitive. Banks and hedge funds have spent millions and I don't know, maybe in the billions of dollars in software development. And they have built data warehouses which are very, very close to exchanges. So these guys, they will build a data warehouse. They will have an algo desk which is within a minute of where the actual trade execution is taking place. They'll buy land or buy property next to stock exchanges to enhance the speed. So high frequency trading is a tough cookie for retail customers. It's not going to be the easiest thing that you have done. Okay, so but what can a small player do? What can you and I do, right? If we want to do algo trading and we want to go make money out there. We can get a brokerage account. We can get automated algos strategies running through our brokerage interfaces. The easiest way to do it is to get a Python algo trading library, which is already there, PyAlgo Trade. You can go out there, download it, and try it out, right? It is useful for smaller players, and also a lot of back testing is done in Python because that's where you do not need that level of speed. So if you're prototyping in a larger company or in a bank, you would use Python, right? And then the final execution after you have done your coding in R or Python and you've figured out a good strategy, 9 out of 10 times you will actually get a coder, right? A pure software guy who would then transfer your R code and the logic in that R code or in the Python code into C++ code, which will be low latency. All right, we are getting a few questions here. And what I'm going to do is answer some of these at the end of the webinar, because I know that you have some very interesting questions. I just saw one or two of them, but we'll just hold off till the end, I think, instead of stopping right now. So we're going to talk about a few of these rock stars here. Hold on, just let me look at the chat quickly. What do we have? Yeah. Okay. So as I said, we'll talk about this in just a minute. So we are going to talk about the questions. Just take the questions right then. Rockstar alert, Mark Gorton. Mark Gorton, really famous, became really well known for developing LimeWire. If you are as old as I am, you would know that it was one of those very early P2P file sharing programs in the world, really early. Gorton was a renowned trader working on the Credit Suisse prop desk. Went on to develop a crack high-frequency trading algorithm and started this company called Tower Capital. They even have a branch in India here. He followed up with seeding other funds in fixed income after Tower Capital reached a critical mass. Here's the educational background. The quote, which I really liked, it kind of talks about the difference between traditional traders, finance guys, versus the Mark Gorton types or the algorithmic trading. What Mark talks about is what we do is try to identify patterns and trading strategies that might work in the market. And if we find something that we work, we deploy it. We are really an engineering company and have a lot more in common with Google than we do with one of the big banks. Now that's where algo trading is kind of unique in that process, right? Especially the high frequency stuff. When you're not dealing with high frequency, you can work with Python, you can run prototypes, you can work with R. One of the things that we're going to talk about in a bit is statistical arbitrage, right? So which uses a lot of machine learning. So machine learning and algo trading, right? So what is beyond high frequency? Is it all about HFT? Not at all, right? It's not all about HFT. More and more companies, more and more hedge funds are really getting interested in machine learning and trying to figure out how can we make money. A lot of usage of time series models, especially Varmax models. You are using past data, looking at past information, looking at patterns in that past information, trying to figure out what's the optimal lag in growth, right? But at the same time, instead of just looking at past data, you're looking at external factors as well. So our autoregressive moving average model, but with external influences integrated in it. So it's not just past data that you're looking at, you're also looking at external factors like inflation, interest rate, GDP, so on and so forth. One of the key problems for running this kind of model, and I'll bring it up in a bit, and even for regression models, is the problem of multicollinearity. And I'll talk about it in a second. We also use a lot of panel data models, which are very similar to your regression models, but these are for cross-sectional time series data. Most share market data, right, especially if you're dealing with end of day pricing, right, that's cross-sectional time series. It has a time series element to it, but if you're looking at a certain sector and looking at 20 different stocks in that sector, there are 20 separate unique stocks, plus you have a time series. So these are cross-sectional time series data, and you would need to work with panel data models for it. You just don't want to use time series data models, all right? Regression models are also useful. And one of the key reasons why they become useful is, of course, to study underlying factors. The problem there, too, is continual problems of multicollinearity. What is multicollinearity? Some of you already know if you have dealt with regression models. It's essentially your independent variables, which are on the right-hand side of your equation, are very highly correlated to each other. The moment you have high correlation between your independent variables, you still get all sorts of stuff and have error terms which are really, really large, right? So you can use regression models, you can use fixed or random effect models using panel data, but one of the key things that you'll have to keep looking at is multicollinearity and figure out that if you want to use factor analysis to build different independent variables into a single factor as opposed to running with them. One of the biggest ones where a lot of machine learning has traditionally been used among algo trading, statistical arb. Stat arb trading looks at a variety of co-movements in the market and tries to see that can we arbitrage, are there arbitrage opportunities in the market looking at co-movement of stocks or stocks and markets, stocks and sector ETFs. Simple example, I have Bank A and bank sector ETF, right, an exchange traded fund, which is essentially a whole basket of bank stocks. And I have estimated the beta, right, of how Bank A and the bank sector ETF move together. How connected are they, and what sort of what's the beta between the movement of the two? Now, if Bank ETF moves by X bips on a day, and Bank A does not move by beta multiplied by those X basis points, we can expect that Bank A is going to catch up, right? That it's an anomaly. So once I have studied the trend and the pattern over and over again and figured out that this is how the bank and that sector ETF move together, this is what the co-movement looks like, or this is what my regression beta is, the day they do not move together, that's when we sweep in and buy a lot of that stock and sometimes even short the other side, which is the ETF, so that when they come back together and start moving together again, I gain from both sides, right? And I'm reducing the risk by taking the long on one stock and short on the ETF, so that if it diverges, I still do not worry about it. I'm still hedged out, right? I'm still essentially, it's an arb position, it's an arbitrage position. So regression models have been used traditionally in StatArb, but one thing to remember, it is never linear. It is rarely ever linear. So what do we do about that? A lot of signal processing, technical analysis type trend watching. Instead of using linear models, use polynomial models, look at transformations, so on and so forth. You will need to learn a bit more about filtering processes or signal processing if you want to go down that direction. But the key here is that a lot of the stuff that we are doing, right, in data sciences, or at least in basic data sciences, a very large part of it assumes certain things like normality of returns, assumes certain things like normality of error terms, like linearity of movement, and a lot of these do not really hold. Another place where machine learning algos are getting fairly popular as part of algorithmic trading is sentiment analytics. Still in nascent stages, but if you look at your terminals now, you would see that a lot of the vendors, the Bloombergs and the Thomson Reuters of the world, actually provide sentiment scores which can feed in directly in your into your algorithm. So it's getting popular, especially using live Twitter analytics from their live Twitter Firehose data. All right, so what I'm going to do is end on the algorithmic trade part here, move on to derivatives. I'll just check how we are doing on time. So it's about 10:30 here. We have about half an hour. So I think we're good with time here. We have about half an hour. So what I'm going to do is talk about derivatives first, move on to fixed income, which is arguably much larger than equities markets, especially in developing markets, and then throw it open for questions. So what is a derivative, right? Most of you would know what it means, but the notional size, okay, of the derivative market is about 1.2 quadrillion US dollars, which is a quadrillion is about 1,000 trillion, right? So when Warren Buffett called derivatives, financial weapons of mass destruction, I think the biggest reason was that the size of the notional value is so large that if derivatives move in certain directions, right, as we saw in the financial crisis, the global financial crisis back in 2009 or 10 and 11, a lot of really large companies can go completely bust. One of the key examples here is AIG, the insurance company. They had a really tiny group called AIG Financial Products, AIGFP, which insured a lot of mortgage-backed securities, right? And when contagion happened in the market, that everything started moving in the same direction, right? That tiny little part of the company, which probably accounted for 5% of its revenues, crashed AIG, and they forced the government to bail it out, right? So simple example of a derivative, what happens and why it becomes such a large notional and why it's such a problem sometimes. Let's think of a simple stock, IBM. Suppose it's time 0 today and the stock trades at $60, and let the option strike price be $62. So the payout when you have a strike price of 62 is at maturity. When your option matures, If the price of that stock is greater than $62, you make the difference between the current price, right, when the option matures, and 62, which is your strike price. So let's say it trades at $65 after 3 months when the option is up for maturity. You make $3 per stock, right? If it trades less than $62 on the day of maturity, you make 0 because you've already paid for the option, and the option gives you the right to buy, a call option. So you don't lose a lot, right? You only lose your options value. Now the question which all hedge funds, banks, investors are trying to understand is, how much would you pay for this option today? This does not seem too complicated, but there are a lot of moving parts in derivatives, and we'll talk about some of them in a little while. One of the key features here is the enormous amount of leverage that you can get in the derivatives markets. With $100 and if the price of buying your option is $1, you can buy the right to buy 100 IBM shares, and you can gain nearly as much as a shareholder who has bought 100 shares of IBM with $6,000 at that $60 price, right? If the price moves above 62, you gain as much or nearly as much based on what your options price is as the guy who bought a share. But the guy who actually went and bought those shares had to pay $6,000, whereas your trade might cost you just 100. Right? So that's why it allows for a lot of leverage. So this is the field where quant finance really took off. Equities, algo trading, even HFT came significantly later than this. This is where the physics and math PhDs started coming to Wall Street. The proliferation of quant models started with the seminal work of Scholes and Merton. Scholes and Merton won the Nobel Prize in economics for the Scholes and Merton model, and Fisher Black unfortunately had passed away by then, a couple of years before the prize was announced. So this is what the equation looks like, right? There's a partial differential equation, and what does it mean, right? F here is the price of the derivative. S is the price of the underlying instrument, which might be an equity, often equity, and R is the risk-free rate. So all you have are 3 moving parts, right? A partial differential equation on how your price of derivative changes over time, multiplied by your risk-free rate and the price of the underlying instrument, and that multiplied by your change in the price of derivative with a change in the underlying instrument, and then you multiply that with half of sigma squared, which is your variance, S squared, the price of your underlying instrument, and again the double differential of how your price of derivative changes with the change of price in your underlying instrument is equal to RF, right? Now, really neat, okay? Coming to think of it, the math for this is not very difficult. You can even model the Black-Scholes out in Excel and estimate optimal options prices, right? Sometimes we would use actual options prices, use the Black-Scholes model to back calculate implied volatility as well, right? If you want to dig a little deeper, there are lots of papers out there which give you the entire details of what sort of assumptions it has and so on and so forth, and the derivation. But as I said, the math is not very difficult, okay? Because what Black-Scholes and Merton did was they looked at past prices, essentially put that in a partial differential equation and said, look, all you need to do is look at the first derivative and second derivative of the movement of the price of the derivative, right, with regards to the change in price of the underlying equity or underlying instrument. That is your key identifier for what's going to happen to prices. But as we know very well, that for all wonderful equations like this, which are fairly easy to understand and the math is easy, there are lots and lots of underlying assumptions. So using your Black-Scholes PDE, this is what a simple call option price would look like, right? Where C is your theoretical call value, S is your current stock price. Look, we are using the cumulative standard normal probability distribution here on D1 and D2. You see the log terms in D1 and D2. Thus, what we are assuming here is that your returns are distributed log normally. This is one of the key assumptions which are, argued about incessantly by these PhD quant finance types for years, and there are lots of new models coming up where you can actually move away from these traditional Black-Scholes assumptions. I will not go through and talk about the derivation of the model or talk about each one of these, but it's here. Do take a look. And this is where it kind of all started from, right? This is where the quants came in. So simple model, looking at clear data. What are the key inputs here? Current stock price, the number of days until the option expires, the option strike price, your risk-free interest rate, and daily stock volatility. All these pieces of information are readily available for an individual trader as well, right? And let me remind you, especially if you're thinking of the Indian context, our options markets, right, are fairly liquid. They're very large. They're deep. So if any of you are interested in getting into options trading, this is the kind of stuff that you can absolutely begin with, because you will find Excel sheets online transferring, and you can try this. You can do this at home, right? Given the limited data needs to transfer a formula like this and transfer it over to Excel. So what happened with Black-Scholes and Merton, the legendary Nobel laureate quantitative finance? So while Wall Street was getting enamored by these math geeks, there's a lesson to be learned here. Long-term capital management, the enormous hedge fund which was supported by Scholes and Merton, crashed. And it nearly caused a recession in the United States. I mean, there are other factors, but LTCM and the fall of Russia and the crashing of the Russian bonds happened at the same time. Everything started moving in the same direction. The hedges that they put together did not help at all, and LTCM crashed, right? So this is one of those stories. Anytime you start working in quant finance, right? This is one of those cautionary tales that everybody on the street knows about and remembers that, you know what? Let good economic reasoning, business thinking drive trading strategies, and not just completely depend on purely mathematical black box models, right? While you can do a lot of it, sometimes when past data stops reflecting what's going to happen in the future, you might get into a lot of trouble. Because some of the assumptions, like your returns are log normally distributed or a random walk, right, might just be too simple. Thousands of quant models started off by tweaking around Black-Scholes assumptions and backtesting them for success. So random walk down Wall Street, random walk, you must have heard about the term. If you have not read the book and are interested in making money using quantitative models, Burton Malkiel, who's an emeritus professor of Princeton now, the new edition that came out in 2016, do take a look. What it will show you is how it is nearly impossible to make money in stock markets consistently, and the underlying math for it, right? As more and more algo trading software algorithms proliferate in a market, it gets more and more difficult to figure out inefficiencies in the market and make large chunks of money, right? It gets more and more difficult. At that point, you can only win on technology as opposed to coming up with new ideas and algorithms. In India or in some other developing markets, I think there's still a lot of scope to look for inefficiencies, but in major markets, there are so many players looking for those inefficiencies all the time that it's probably fairly difficult to get a leg in. So what is a random walk? It's an assumption of the Black-Scholes model, and it suggests that people cannot consistently predict the direction of the market or an individual stock. So the Black-Scholes model assumes that stocks move in a manner which is called a random walk, which means that any given moment in time, the price of the underlying stock can go up or down with the same probability, and the only or the primary thing which you know about that movement is the price of the stock yesterday, all right, in the previous time period. So the price of stock and its movement in t+1 is independent from the price in time t, okay? So that error term, right, where yt is equal to yt minus 1 plus et, which is your error term, where the expected value of your error is 0, all that means is that tomorrow's price can best be estimated by yesterday's, since the error term is white noise. Now, once you have taken that to be one of the key assumptions, what you're saying is there are very limited trends, right, or time-based trends in the market. Markets are very, very efficient or hyper efficient. Hyper efficiency in the market is pretty much assumed away in Black-Scholes in some ways, right? And that's what creates the problem, especially when you're trying to bring it to a developing market perspective. All right, so we're going to talk about one more rock star here. You will see that other than Paulson, who we talk about right at the end, I don't talk too much or try to talk too much about these rock stars as individual trading strategies, because anyone who works for them, they have a gag order saying that forever in your life you're not going to talk about our strategies, our internal strategies, because if you do, I'm going to really sue you, right? So David E. Shaw, PhD from Stanford, became a faculty in computer science in Columbia University, left all of that to start his own fund. They don't consider themselves an HFT. Only 25% of their models are short-term models. Thus, they're one of the ones who are definitely largely more inclined to machine learning strategies. Their market-beating algorithms are so secret that even limited partners don't really know what's going on behind the curtain. Shaw himself would give out very little, and when asked, this is a description directly picked up from an Huffington Post article about David Shaw, where they interview him. They said that he will give only a coarse description of stat-arb strategies his mathematicians have invented, which are designed to exploit tiny pricing mismatches. The key here, right, two things. One is, as I mentioned, stat-arb, right, is one of the key areas where hedge funds or larger banks or prop trading desks have been using machine learning. And that's probably where many of us who are data scientists would want to focus. What it does is it looks at these tiny mismatches, as we mentioned, a single bank stock versus the bank sector ETF, right? Kind of diverging movement happening somewhere. Why is that divergence happening? If there's no underlying economic reasoning for it, at some point they're going to converge back, and the co-movement, right, mean reverts. So Shaw talks about the same thing. He says that, you know what, we do stat-arb, and we have mathematicians, and they have come up with these designs to exploit these tiny pricing mismatches. The word to note is tiny. Unless you have a fairly large amount of money to trade in very liquid, very efficient markets, it can get fairly difficult, right, to make large chunks of money doing stat-arb, all right? Which is why, for an individual player, even though it's very risky, right, never recommended to go all out and do something like this, options are the way to go, right? Because if you're playing with equities, the cost of execution is so large, right, that the little bit that you can make from statistical arbitrage, the little bit that you can make from these, pricing mismatches can get lost in your transactions cost per se. Shaw says that his strategies are market neutral. As I said, that if you buy a share and short an ETF in the same sector, you're essentially going market neutral. You're hedging out a large part of your risks. But he also mentioned that if he really knew how to be market neutral, we would definitely have done that. Nobody can be fully market neutral, right? You cannot hedge away all your risks. What D. Shaw has done now that they are like a $40 billion fund is you will see that they have diversified away into a variety of investment areas, from private equity to doing some venture capital. They have done, I think recently, they did some co-investments in real estate as well, treasuries, so on and so forth, because it's a crowded space looking for pockets of inefficiencies. All right, so talk about risk quants. This is really a very large sector as far as hiring goes. Very, very well paying as well. But in financial market snobbery, if you can't make it as a desk quant, you land up as a risk quant. Okay. Now, I think that's a little bit of a snobby statement to make, because risk quants effectively do work which makes sure that your fund survives, because your traders can go gung-ho and start losing a lot of money, and these risk guys are going to be the ones who are going to make sure that they don't. That doesn't make their models any less cool, and sometimes they're fairly, I would say sometimes they're cooler. The only biggest difference is the desk quant is right next to the money, whereas the risk guy is probably a little bit further away. So concepts like value at risk, internal external ratings for commercial banking, things like z-scores, that how likely is it that a company is going to go belly up. The variety of ways that value at risk can be calculated, the variety of ways that you can credit score some companies and so on, that's the job of a risk quant, all right? It's I think, one of those areas where a lot of machine learning is being used, or traditional algorithms are being used. Things like support vector machines, things like logistic regression is kind of par for the course for most risk quants. We'll move on to fixed income securities, which is another large area for quantitative finance. A lot of it is not algorithmically traded, but they're supported by machine learning, supported by quantitative finance. And the reason why they're hardly algorithmically traded is these markets tend to be over the counter and therefore tend to be fairly illiquid. In developed markets, if you trade in equities, you probably didn't get to trade in fixed income, because that's where the big kids play, right? Especially in Wall Street, right? And securitized products and treasuries, securitized products of all sorts put together, right? Your mortgage-backed, asset-backed securities are the second largest asset class in the US, just after US treasuries. Okay, so we are going to talk about asset-backed and mortgage-backed securities, and these, as you might recognize, use a lot of terminology which you might be familiar with. Things like probability of default, loss given default, exposure default, so on and so forth. One of the key reasons why a lot of folks here are familiar with this terminology is this is also the terminology used for measuring risk in these sectors. And so if you have worked with anything related to risk compliance, like Basel II, Basel III norms, if you have worked with any banks doing risk-related material, figuring out what the value of risk is on a bank's book, these are terms probably that you have already seen. And the good thing is there's a lot of machine learning that you can use here, or traditional statistical modeling that you can use here. So mortgage-backed securities, very, very large market. These are securities that are backed by cash flows from hundreds in case of CMBS, or thousands of loans, right, in case of residential mortgages. What banks would do is, if I am a bank and I give out loans, hundreds and thousands of them every year, I would package all of them together and create a bond. And then I would split it up in different tranches, right, different layers. And these tranches will be based on the priority of the claims of the buyer. So the A piece, they get the first dibs on the earnings from the underlying mortgage holders, and then comes the B piece and the C piece and so on. And at the end, you have the excess interest, right? Beyond all the interest that has been paid off, that is picked up by the equity piece owner. However, to protect the equity piece owner, if things get messed up, the equity guys get to manage the show, right? So you are lowest among all layers in terms of getting the cash flows. All right, you're the equity piece holder. However, because you are so lower down in the pecking order of getting money, you get to call the shots if things kind of go south, right? So banks, what they did was, when they created these mortgage-backed securities, they often kept the riskiest pieces for themselves, right, on their balance sheet. The rest of these mortgages, they packaged and they sold off as bonds to other funds, to individual investors, family offices, so on and so forth. They did this they kept the riskiest piece, and they did this for mortgage-backed securities and other ABS like credit card ABS, student loan ABS, auto loan ABS. And thus, when it blew up, banks got crushed. So during the global financial crisis, you would see that some of the largest banks had to go to the Fed to ask for bailouts, because while they had gotten rid of a lot of the risk from giving out mortgages or credit cards by packaging them out and selling off those as bonds to other investors, they kept the riskiest pieces for themselves, right? And so when things started going south, they were the first ones to get affected. So how do you model securitized products, right? Like MBS and ABS. This was the, the holy grail of modeling MBS and ABS was to estimate the probability of default in the underlying loans. But the unique thing, or the amazing thing, is that most banks ignored to model individual loans before the financial crisis happened. They would look at the broader bond, treat it like a corporate bond, when they should have known, and they knew very well, that it's not a corporate bond, and there are thousands of underlying entities who have to make payments on their homes if the bond has to make money, right? Because who would want to analyze all these 80 million mortgages? And this was before big data became big, right? So I know some of you are thinking, why can't we use logistic regression or decision trees to estimate the probability of default or the loss given default? Part of the reason why using models like decision trees and logistic regressions, why we do use it. We definitely do use it, and that's the baseline from where we can figure out probability of defaults. Our bonds are unique beasts. And you need to get certain financial concepts to figure out how bond prices function and how they're affected by interest rates, right? So just calculating the underlying probability of default, or just calculating the exposure, calculating what is the loss severity of the underlying mortgages is not enough to price the bond, because you have certain things like duration and convexity. So what is duration, right? And if you want to dig deeper, you can study more and more about these. Duration is an approximate measure of a bond's price sensitivity to change in interest rates. If you look around in finance, in Wall Street, or in liquid markets, larger developed markets, you would see that a lot of the hedge fund managers, or a lot of heads of proprietary trading desks who are doing the really large trades, all come from interest rate traders, right? Lots and lots of them, because interest rate traders understand the thing that is the most important thing for financial markets, which is interest rates. Interest rates are bar none the most important thing in financial markets, period, right? So if you are someone who understands the concept of interest rates, how interest rates affect everything in an economy, every financial product, every bond that you can think of, once you get that concept very clear, it really helps if you are getting into financial markets. So the duration of a bond is the bond's price sensitivity to change in interest rates, right? And then you have convexity. This measures the curvature in the relationship between bond prices and the interest rates, right? So this is kind of the second differential of bond prices and how they change in terms with interest rates. The good thing, thankfully, with ABS, MBS is the waterfall structure, that who's going to get what and when, and parts of these convexity adjustments are usually modeled into proprietary software. So you will have things like Intex, which, if any of you are working with mortgage-backed security markets, would know about, which has already tried to model in some of these. So we'll talk about our last rock star here, somebody who was, at that point, the big villain or the big rock star, whatever you want to call him. This man is the Big Short, right? If you've seen the movie, it's not about Paulson, but he is the guy who pulled off the biggest short in history, I guess, especially in the residential mortgage-backed security space. They made billions and billions of dollars short selling RMBS, right? So a short sell is, if you're not familiar with the term, short selling is when you short sell something. If the price of that stock or that bond goes down, you make money, right? So you're essentially taking the counter side and saying that the price is going to go down. You borrow the share from someone and sell it to, if you can borrow the share from person A, sell it to person B. so that when prices go down, you can buy it from the market and give back the shares to person A at the lower price. So you're betting that prices are going to go down. So Paulson and his head quant, Paolo Pellegrini, could see that the disaster was about to strike in the housing markets. Now, how do they do this, right? Because everybody, the banks, the Fed, everybody had the same information. You can get information on mortgage-backed securities, loan by loan, month by month, whether people are paying on them or not. If you buy, you know, a loan performance database, which is expensive, but investor can buy it, right? Because banks did not do their homework. Banks got lazy. They were happy with, you know, MBS prices shooting through the roof, home prices going up quarter over quarter, and they stopped doing their homework, which is when the Pellegrinis of the world, and if you've seen the movie, players like that actually looked at the underlying credit, right? The underlying millions of underlying loans on those thousands of RMBSs, studied that, figured out that these are going to, you know, these are in trouble. They augmented that data with macroeconomic and home price data. And this was all before big data became a buzzword. There was no big data, or big data didn't become what it is today, right? So there were platforms like 1010 Data, if you have seen that, where you could actually go and run and work with all of these in cloud, right? Before cloud computing was a term popularized and everybody knew about. So you must learn simple algos like logistic regression or decision trees to look for defaults, but you have to be willing to go beyond it. One of the models which have been most successful in the mortgage-backed or asset-backed space is called roll rate models. These are essentially Markov chains. So if a person was 30 days late in paying his mortgage, what is the probability that he's going to move from the 30-day late to the 60-day late bucket, or move back into not late anymore by paying off their monthly payment, right? These probability questions, if you can answer these, right, just look at past data, yeah, and looking at mean reversion, looking at historical data, and building a Markov chain model there, you will be able to figure out with surprising levels of accuracy that which amongst these people that you're looking at, these millions of people that you're looking at, are probably likely to default. Okay, so Markov chain models became very popular after it was a PhD thesis from someone, and you know, asset-backed, mortgage-backed securities use these roll rate models very, very often, going beyond simple traditional models like logistic regression or even decision trees. So that's what I have for today in terms of you know, the slides, the webinar, the structured stuff, and I think we've gone through exactly about an hour. So I'm going to throw it open to questions. So I'll just open it up for questions. Kunal, do you want to take over now, or how do you want to do this?
Yeah, so let me kind of read out the questions to you, and then you can kind of answer them. But before that, I mean, thanks for that wonderful presentation. I remember reading the book called "When the Genius Failed" about LTCM.
LTCM, yeah.
The kind of best books I've read on that. And then the other thing which I noticed was if you can go to the Rockstar slide on D. Shaw.
Yes.
So,
yeah.
So I think if I put his photo and your photo to a face recognition algorithm, you would.
Thanks.
Yeah.
Yeah, I'm getting there, I guess. Thank you. I'll take it as a compliment.
Yeah. So I'll come to the question. So,
please.
So the first question is, why do people prefer C++ or Java over R programming for algorithmic trading?
Okay. So do you want me to answer it? Yeah, let's just do that, right, one by one. Yeah. Sure. So C++ and R, because R and MATLAB are compiler based, they are compiled line by line, right? So what that does is it makes them much slower than optimized C++ code. As far as speed goes, right? the way C hash or C++ or even Java, the way they interact with your hardware, you really cannot beat that, even now. So in the world of quant finance, right, when you're trading, buying bonds, or if you're, doing something small scale, right, if you're using machine learning strategies to come up with, ideas and saying that, oh, look, I found this, relationship between this stock and that indicator, and moment they diverge, I want to buy this, or things like that. That's a slow process, right? But whenever there's a large need for speed, you cannot beat C++ and Java, and that's it. It's a speed story more than anything else.
Sure. Okay. So the next question is from Karthikeyan, and he's asking what kind of analysis can be done for the stocks using the end of day pricing, which typically gets published in media.
Yeah. So Karthikeyan, good. This is really good because it's an applied question, right? You and I, we don't have access to tick by tick data and all of that, right? What can we do? What we can do with end of day prices is, what I talked about, stat arb, right? Statistical arbitrage, what it does is, let's say if you look at a fund, right, or an exchange traded fund for the banking sector, right, or an index for the banking sector, right, and there are 10 or 20 different stocks in that, right, and the regression coefficient over time of one of these underlying securities, right, if we look at that connection, that co-movement, we can see using end of day prices that in certain days the co-movement does not happen. The regression beta that you have seen, the movement is not in line. Okay, if that happens, the quick thing to do is check that is there any underlying economic reason? Was there a new piece of information that we didn't know about, right? If not, then you might have an opportunity right then. So I think, using time series data, time series models, using especially VarMax models. I'm very partial to VarMax models, and I've used it in different places, right? From stock markets to working on, predicting hybrid seed sales in Asian countries for rice. I've used VarMax in a variety of roles, and there we used, end of month data. We have even used quarterly data and used time series VarMax models. So with end of day modeling, I think if you're looking at time series, you might get good opportunities in stat arb because that's something that people tend to ignore. And our markets are not as as efficient, crazily efficient. There is quite a bit of room. So I would say go with stat arb. I think end of day pricing, you can do something interesting with stat arb if you find the right set of stocks that you're looking at and the right indicators.
Sure. Thanks. So the next question is from Mohit, and he's asking, what is the scope of KDB database and Q language in this field, since most of the banks use it? Will learning it be beneficial, specifically for a guy who is starting out in the field of analytics? KDB database and Q language. I don't know what they are. So I'm sure banks are using them. They sound familiar. I don't know much about them to comment. But you know what? One thing I'll tell you, right? If you really want to get into the heart of the beast, you can choose two paths, right? And I'll tell you what I chose. And because I got to, for good or for bad, I got to hang out with a lot of these physics PhD type quants, right? And they were really intelligent. I mean, I would get crushed at the end of day because I would think that, wow, these guys are brilliant and I'm such an idiot. But if you want to go and get into HFT and go work for a bank doing HFT, then focus on your C hash, C++, Java coding skills. I chose against it while I worked a lot with algos, but I chose against specializing in that because I knew that I was never going to be that good a coder. So I chose the second path, which was learning more about quant finance models, learning more about machine learning algorithms, statistical models which can be used to predict default,
and also understand the financial implications of those. So understand duration, understand convexity, understand how interest rates, affect everything, prices, so on and so forth. Even in the case of stock markets, right? Look at relationships, learn more about panel data models, learn more about time series modeling. So, if you choose to go the HFT route, go pick up, serious Java skills, right? While learning more about finance. If you want to go more the machine learning path, which is kind of what I chose, then Python or R would be the kind of tools that you would be looking for. Don't kill yourself about some particular database that somebody is using or some banks are using. The underlying structure of those databases would not be very unique or very different from what you've looked at. Yeah.
Thanks, Deep. The next question is from Shekhar, and he's asking that I've heard that there have been some regulatory changes with respect to algorithmic trading or high-frequency trading.
Yeah.
That has affected volumes. Can you please elaborate on that, and how are players changing their strategy in light of these regulations?
Right. So, couple of regulatory. I mean, if you're talking of the Indian scenario, I can tell you what's. I mean, somebody was talking about it the other day because so SEBI has kind of really woken up to the fact that certain banks and so on were probably being advantaged and getting some leeway, getting pieces of information before anybody else could. So what SEBI is trying to do now, this is still work in progress. It hasn't happened yet, or if it has happened, it probably happened 3 years back. I don't know about it. But what SEBI is trying to do is any piece of information gets embargoed in a way that your retail investor kind of gets to know at the same time as your institutional investors. So funds or banks would not get a time advantage, right? So Shekhar says, yes, it's the Indian context. So they would not get a time advantage over the smaller players, right? So yes, regulation on this, it's in the pipeline. It hasn't, I think, been done yet. If I remember correctly, it's still on the pipelines, but it is going to happen. I think SEBI sounded pretty serious from a couple of notes that I've seen about it. What that will do is, this whole thing about buying the property right next to the stock exchange because I'll get a picosecond of advantage, that is going to change. And from a retail investor perspective, it's good. Personally, I'll be happy. Yes. So Shekhar asks, is the information asymmetry then lost? It's not completely lost. Think about it. While SEBI can say that the information is going to go out at the same time to everyone, it cannot tell you that you cannot use better pieces of hardware and software so that as soon as the information reaches you, right, as a bank, you make the trade faster. You do the trade faster. Secondly, you do a larger trade and break it up into pieces in such a manner that you get the best execution. These kind of things you cannot control. Will you lose the information asymmetry a bit? Yes. I think it's a net positive for the retail investor. Definitely, it is a net positive for the retail investor. Banks will cry foul and they will try to stop it from happening. I know that. I mean, I've dealt with banks. I've never worked for a bank. I've always been on the buy side as opposed to being on the sell side. So I'm very careful about banks. They'll try to stop something like this a lot. Yeah.
Sure. So I think we have 2 more minutes. I'll take 2 last questions. So one of them is from Harsh, which says, which machine learning or predictive analytics techniques can be used for pricing foreign exchange derivatives and interest rate derivatives?
Okay. Forex and interest rates, both very, very liquid markets. With Forex, it's a very difficult game. Because Forex, if you are looking at longer time frames, it's completely a macroeconomic story, right? The interest rate differential between 2 countries and the inflation differential between 2 countries are the only 2 key reasons why foreign exchanges diverge or converge over time, right? So difference in interest rates between country A and B, and difference in inflation rates. However, in the short term, a lot of people use a lot of technical trend watching tools. I am not a huge technical trader, I sometimes, while I do study trends and patterns for a living, I sometimes think that some technical analysis goes to ridiculous levels. Having said that, if everybody believes in something, it's self-fulfilling, right? And technical strategy is kind of that. So for forex markets, what I would do is learn my time series very well. Same with interest rates. Interest rates, forex, even some commodities markets. Commodities markets are of course seasonal. There's a lot of effect on what happens in the macroeconomy. All these three things, learn time series models very well. Learn VAR-max models. Make sure, especially if you're dealing with a bucket of foreign exchange currencies, right? Because you want to look at 6, 8, 10 of them. Make sure you learn a little bit of panel data models, right? Because you're going to look at 8 different ones at the same time. But I think time series models, VAR-max, definitely key to kind of figuring out the trends and patterns. But the caveat that I would definitely give you here, and it's not because my primary training has always been as an economist, is do learn about the economics behind it, because it's a very macro story. So don't get caught wrong side of the trade. Quick example here, the yen carry trade, right? That you borrow in yen and lend in the US, right? Which was called the yen carry trade. It was one of those trades that for probably a decade, everyone knew that you can make money if you do the yen carry trade, right? Borrow in the low interest rates of Japan, lend out in the high interest rates of US, right? And then sometime around the financial crisis, because yen started strengthening so much and so fast because it's a safe haven currency, I think probably a few $1 billion were lost in the trade. So keep your eyes on the macro story as well, if you're dealing with forex or interest rates.
Sure. Thanks, Deep. Another interesting question is from Abhishek, but I'll also kind of generalize it. So Abhishek is asking that he's starting his internship with an algo trading company in a few days. So any tips you have for him? But in general, if someone wants to kind of start a career in this domain or is joining a company in this domain, what are some of the tips you can give for getting into data science in this company?
Okay, so let me this is kind of generally broad based, and I realized this when I started working in a fund. And I'm a PhD dropout. I went to the University of Texas Dallas to get my PhD in economics. I finished my coursework and then I dropped out because I wanted to go make some money, right? So when I worked for a quant desk, right, and did quantitative finance, I used my econometrics learning, right, as much as I did when I was writing academic papers. You will have to spend, if you want to break into this field and do well for yourself, plug and play is not enough. You cannot be like, hey, look, here are 5 data sets. This is the price that I'm looking at. I'm going to put it in R, run an algorithm, get some time series forecasts, and maybe this is going to go up or this is going to go down. Don't cut it. If you really want to do well in the quant field, you have to dig deeper into financial econometric or time series econometrics theory. And Andy Lowe, the guy who runs the quant finance program at MIT, he has a wonderful book called Financial Econometrics or something like that, right? Very difficult. Okay, I found it really difficult when I was working through the problems, and there are a lot of practical examples based on those. But if you want to do well in this field, you have to really build up either or both your coding skills and your econometric skills. There will be no shortcuts. I mean, because there are so many, think about financial markets, right? Everyone's trying to make money in financial markets. There are very few people who are looking at marketing analytics. There are very few people who are doing HR analytics, but everybody is investing in the markets, right? Nearly everybody and their brothers. So it's a very crowded space. If you really want to make money in financial markets, doing algorithms, doing quant finance, you'll have to ramp up your math skills. So my recommendation would be go look at, and Akash here is asking me that any books for reference in quant finance. Two things. So go learn your core statistics very well. Go learn your core time series very well. So that's my recommendation, right? Go pick up a good, difficult financial econometrics book and work through it. All right. And book references and Coursera course references. Kunal, I'm just going to take these questions directly from because it kind of lines up with what I'm talking about from the chat. Book reference, I mentioned Andy Lowe, but that's a very difficult book. The guy to really follow is this guy called Paul Wilmot. Paul Wilmot, PhD physics, I think. One of the guys who was right there in the beginning of quant finance. Wilmot has written multiple books on quantitative finance. He's the guy who started the CQF certification, Certificate in Quantitative Finance, which I looked at, but it was so very expensive. I couldn't imagine spending that kind of money for anything, right? Forget about a course. But it's a good course, it's a good program. I saw the program details. I saw the people who are teaching in it, really strong. So Wilmot wrote a book called Wilmot on Wilmot. And I think he has 2 volumes, books called Paul Wilmot on Quantitative Finance, Volume 1 and 2. Really good places to begin. The other one is this guy who's a friend of Wilmot's, co-author, Emanuel Derman, right? Emanuel Derman, D-E-R-M-A-N. He wrote a book about 6 or 7 years back on, how life is for a quant and things like that. Lots of anecdotes, lots of stories. Really a good place to begin if you're getting interested in the field. So I would recommend anything by Wilmot, especially Wilmot on Wilmot and Wilmot on Quantitative Finance 1 and 2. Courses, Coursera has a course on financial engineering and quantitative finance by Garuda Iyengar, I think that's the name, Columbia. And it's called Financial Engineering and Quantitative Mathematics, Financial Mathematics, something like that. There are 2 parts, right? Very good to understand the underlying math, but they take a risk perspective though. Their perspective is very risk centric. So I would say that that's the downside of the course, but excellent course. I have looked through it. I actually downloaded all the lectures and looked through some of them, really good material. So Garuda Iyengar, Financial Engineering and Risk Management or something it's called, and it's in 2 parts, and it's from Columbia. So go to Coursera, look it up. I think it's pretty robust. Good place to learn the math.
Sure. Thanks a lot, Deep, for taking time out in this webinar. It's late, but I'm pretty sure. So there was a ton of information for people to kind of absorb and reflect, and it clearly comes from a lot of experience you had. So thanks a lot for taking time out, and then we hope to see you again as part of our community initiatives. Sure,
absolutely. I mean, as someone who spends a large part of his time as a faculty, as a teacher, my bread and butter is running Dono Consulting and working with funds and market research companies, but I teach and I do all of that. So part of it is I think just spreading the word, right? I mean, I don't think I have anything new to say, but I'm doing it for some time. So if it was helpful, I'm really glad if it helped you guys out. And if you want to reach out to me, I'm of course on LinkedIn, and you can just drop me an email or anything. Happy to answer back. So not a problem at all. We should. Kunal, what you have created here with this community is amazing, unbelievable, and I think AV is doing a fantastic job. Right, I really feel that. So good stuff, man. And if there's any way I can help, of course, not a problem at all.
Sure. Thanks a lot, Deep.
All right. Thank you. Bye, everyone.
Thank you. Thanks. Good night, everyone.
Good night.